All right, hello again, ladies and gentlemen, and thank you again for joining us today for the FASB CECL model, why waiting for changes may cost you. Before we get started today, just a couple of quick housekeeping items to go through. First, all attendees are in listen-only mode, so there's no need to worry about any background noise on your end. Second, slides are available for today's presentation. You'll notice that this is in a slightly different format than your typical PowerPoint presentation, but a PDF of the slides can still be accessed via the GoToWebinar panel, and you'll also receive an email following today's presentation with that information. Third, we do encourage questions throughout today's broadcast, so in order to do that, utilize the GoToWebinar panel as shown on your screen, and we'll save some time at the end to address those questions. Finally, we will have a few live interactive polls throughout today's presentation, and we encourage and appreciate your participation in those. Before we get started, just a quick blurb about Sageworks and CliftonLarsonAllen, who have partnered to produce today's webinar. Sageworks is a financial information company that provides credit and risk management solutions to over 700 financial institutions across the country, and it provides resources on the ALLL, stress testing, and credit analysis available at sageworksanalyst.com. CliftonLarsonAllen is a top 10 accounting firm serving over 1,100 financial institutions across the country with over 200 professionals, including 25 partners who focus exclusively on financial institutions. Finally, I'd like to go ahead and introduce today's presenters. We're very excited to have with us both Todd Sprang from CliftonLarsonAllen and Ed Bayer from Sageworks. Todd Sprang is a principal in CliftonLarsonAllen's Financial Institutions Division, and he is also a member of the AICPA Depository Institutions Expert Panel. Ed Bayer is the Managing Director of Sageworks Financial Institutions Division, and he previously served as a Senior Risk Management Consultant focusing on the ALLL. So this time, I'd like to go ahead and turn it over to today's presenters. Ed, if you could go ahead and take it away.
Thanks, Billy. Appreciate that. Appreciate the introduction. Todd, appreciate you joining today on the call, and most importantly, audience, I appreciate all of you taking time out of your day to be here. This topic seemed to be very important as we received our largest registered attendance by almost 50% ever before. So we imagine this has a lot of great value to you. A lot of good insights should be shared on here, and Todd and I are both eager to put this webinar on for you today. To get started, we did say it was on, why waiting for FASB changes may cost you, and of course we're referencing the FASB changes on the CECL model that they proposed. At this time, I believe it's been out for over a year, but it's important before we go through some of the specifics to make sure we're all in the same place and have an understanding of the model. Todd, if I can bring you on, can you walk us through, give us the background on the model at this time?
Sure, I can just give you a few points, Ed. Appreciate sharing that with you today. When you look at where this has gone, the proposal did celebrate its first birthday about 2 months ago, and as we look, how does it impact financial institutions? I won't cover all the criteria in the model, but just a few of the highlights to kind of take us back from December up through maybe the late fall, and what are we looking at. The differences from the proposed model, expected loss model, from the incurred loss model that's currently utilized is the forward-looking requirements in the CECL model. There are 6 components at a high level in that proposed model, which is expected to estimate the present value of cash flows that you're not going to collect using some quantitative and qualitative data. And the first 4 criteria that most people are familiar with is when you think about your allowance now with its historical loan loss components, qualitative factors, and specific reserves on impaired loans, you really capture the first 4 portions or criteria of that CECL model, which are taking into account past events, historical loss experience, current conditions, and borrower creditworthiness. Really, those are all things already that your model incorporates. But the 2 additional criteria that were added for CECL were forecasting expected credit losses, looking out into the future in that expected loan life and trying to forecast what those cash flows or cash flow shortfalls would be, and also taking into account the current point that we are in the forecast direction of the economic cycle of the portfolio. So those are the forward-looking requirements that I know have received the most attention. Then also the probability threshold. This was pointed to as one of the flaws in the current incurred loss model that prevented institutions from recording losses that they could foresee, but were prevented because they didn't meet the probability threshold. That was one of the comments that we had on the initial proposed model, is if the threshold is the problem, why not fix the threshold, right, rather than starting with an initial a new model. And then of course, as we look out into the future, we're taking into account a longer loss horizon, where most would say that the current incurred loss model takes into account maybe the next 12 months of losses. Some of the initial estimates on how it might impact the allowance were saying, you know, multiples of that, and that was because the loss horizon that you're looking out over is probably a 2 or 3, at least a 2-year, probably a 3-year or more loss horizon. So you'd expect that allowance to grow at a multiple. So again, under the expected loss model, we're looking out probably about 3 years versus about 1 year, discounting those back, because the time value of money does have a role in this. The present value would be the discounting those cash flows back at the rate of the loan to get to the present value of that. So those are the major components that impact financial institutions of this expected loss model as it was proposed in that draft from back in December.
Thanks, Todd. Appreciate that background as well. And another bullet on there has been one that several of us heard. It's saying OCC's had Thomas Curry expecting the allowance to possibly increase by 30 to 50%. There's been, as I said, about common known at this point. We did a webinar similar to this on a CECL model being proposed roughly a year ago, almost a year to the month, asking at the time when it was very fresh, you know, how people thought it would impact the reserve then. Since then, obviously, there's been a lot of debate, some comment letter themes that we'll get to, but a lot more conversation, and we're curious how that has changed, basically our audience opinion of how they think the CECL proposed model will change. So at this time, we're going to go ahead and show our first question. It should be coming up over your screen at this time. On now, how do you feel FASB CECL model will impact your ALLL? This is an interactive poll, so if you can go ahead and just take just a moment and click on this. We're going to share these results in just a second to the audience. And then after we share these results, we're going to compare the exact same poll almost 1 year ago on the thoughts on how this was going to increase your reserve. So we have got about 58% have voted, and that's growing rapidly. So we shouldn't need much longer than 10 seconds to wrap this up. I appreciate the willingness here as you're participating. So we'll say 5 seconds. And let's go ahead and cut this off, and we'll go ahead and share these results as well. So if you look right now, it's saying how will the model impact your ALLL? We still have, and this is in line with what we saw before, over half the participants are saying it's going to increase your reserve by 10 to 50%. This seems to be in line in what even Thomas Curry was suggesting. And then we have the other 30%, if you would, increase your reserve just by less than 10, so still an increase. Only 11% said no impact whatsoever, and a very small portion said decrease your ALLL. That's bold, but that can certainly happen. So how does that look previously? This is what we saw last time we did the poll, which is kind of funny. If you look at increase your reserve by less than 10%, which is the third bar to the right, that's almost the exact same that we just saw the voting. I think now we're at 32. This was 34 beforehand. Increase your reserve by 10 to 50 was just under 50% last time, and the poll we just did appeared to have us at 55. And then no impact and decrease your reserve have certainly decreased as well. So we are seeing maybe slightly, but still saying several agree that this is going to have a significant impact on their future going forward. So that sounds like it means everybody on the call, or the majority on the call, understand that this is something they, if they can prepare for, and this may have a large impact on their institution. And what can they be doing? And we're going to get to that later today. But going on to the next part, Todd, you gave a background moments ago on what it was. Now, when it came out, as you said, a year and 2 months ago, there was about a 6-7 month window to give kind of comment letters as what's the feedback, what are we concerned about. Can you walk through what the overall themes were from those comment letters?
Sure, I can, Ed. You know, if we had put up the polling question on do you support this proposed model or not, we'd know exactly how many regulators we had on the line. Because, I mean, it really does. You draw the line, and I say it, and I mean it jokingly, but honestly, I'm really kind of serious about that. I think the regulators really do like and believe in the proposed model, and others, the industry as a whole, is opposed to it. And I think one of the things that surprised me as we continued through that, looking at those comment letter themes, is if this is done for the purpose of presenting more accurate information to investors and users of financial statements, other than the regulators, that there weren't many comments from investors or users of financials as as proponents for this model. So again, clear distinction. Most, if not all, in the industry really are not in favor of switching this model. I count myself in that camp, in that I'd rather go into the next. And I don't like to use the term crisis anymore, financial crisis. I just say that financial unpleasantry. I would rather go into that period of unpleasantry next time with a model that I'm familiar with and I know its flaws, rather than reinventing a new model and going into the next period and having that model discover the flaws in it at that time. But that said, the regulators believe that the proposed model will correct the issue of too little too late. That was the whole purpose of this project and this model, was to prevent that from happening. I think, again, the industry is much more skeptical about that, in that if I think back to a time when at the, say, 2008, 2009, most were saying at that time they expected that we were in the 7th inning of a nine-inning baseball game, to use that analogy, and I think it proved out that was really inaccurate. So I think, again, the industry is saying, there's no way we would have properly anticipated the extent and length of that of the issues that were incurred during that period. And then finally, I think the overall common theme that there are a few significant pieces moving through that affect financial institutions right now. When you look at, not only is there this impairment project, but a recognition and measurement project on financial instruments that could impact the basis of those loans. And I'm going to keep my comments specifically to loans. When where you could have loans, if as proposed in that model, you could have some loans being booked at fair value, or at least not being booked at the current level of cost basis. So although I think that's changing, it's a little hard to have look at these things in silos, because they can all interact. Recognition and measurement, Basel III, new capital requirements, and a new allowance model, and you put those three things together and you can have unintended consequences. So I think the overall theme, again, from the industry was we really need to be able to have the time to digest some of these things and have them come together and understand the overall impact, rather than looking at them in silos.
No, you're right, Todd, and I think it's a good point, understanding that this certainly has can impact capital, and there's other things going on that are going to do the same, and that can be a scary time for community banks, and that needs to be considered. These comment letters were due, I believe it was early summer. I know it was April, I think, originally, and then it maybe went May, even June before. So it's been some time since those have been submitted as well. So what about recent developments? What can you kind of enlighten us, all of us, on that? We understand that there were some events December of 2013, just 2 months ago, and then maybe even something more recent.
Sure. If we walk that forward, Ed, we went through a period where the comment letters came out. There was also an IASB proposal that had a different comment period. Everybody said we're going to look at these collectively and come together, because FASB had said we're going one way, IASB said we're going another way, and so, as those played out through the late summer and early fall, we wondered where we were going to go with this, and then the FASB comes out, a representative of FASB, I should be clear, at it was the AICPA SEC conference, came out and said, we're going to go back huddle with IASB again. And I got to tell you, that has that dynamic, that relationship back and forth on this project has all the earmarks of like a really dysfunctional marriage, because if it were a marriage, it would be in dire need of counseling, because it's like, I love you, I hate you, I love you, I hate you. We're going to reconcile. Now we're going to go our own way. And it just, if you follow it, it's like a soap opera. So, you know, and here's another example of it again. We came back and in early December, the representative from FASB said, you know, we're going to go back and look at reconciling with IASB and looking at a converged standard. We understand how it impacts the industry as a whole. Regulators are trying to regulate on a global basis and have one set of standards. So with the most significant estimate on the balance sheet, it only makes sense that international standard setters and U.S. standard setters, you know, try to converge and have one standard. And then, you know, just a couple weeks later, at a FASB board meeting, you get some notice that they've looked at different models, analyzed alternatives, and I think it's kind of come out, you know, real recently that, again, I think convergence doesn't seem like it's a likelihood again. It seems like after that meeting, FASB kind of accelerated or indicated we really feel more comfortable with our model and we feel like we're going to proceed. And they're still indicating that they're on that time frame to do something yet this year. I think back at that December conference when the announcement was kind of put out there in those remarks, it was they hoped to have something come out in the first half of 2014. I thought that was too aggressive at the time. That turned out to be right. I mean, but they're still on an aggressive time frame in that they've indicated they still intend to get something out in the second half of 2014, which, again, I anticipate would be probably fourth quarter of 2014 because I think it's going to take a little time to work out. But that said, when under the developments this week, you know, with those swings, you know, I think it's interesting to see. It'll be interesting to see what information comes out because if they're going to make that time frame, there should be some developments now that happen in March and April and May that give us a lot better indicator of where they're moving.
Todd, just to add to that, and maybe a follow-up question to you, you mentioned that we're likely, or we expect to see final resolution on this final guidance this year. As you put it, would you expect it to be very much like the CECL's proposed now, or would you expect any significant changes to the already written proposal?
Yeah, it's a great question, Ed, because if if you'd asked me and you probably did ask me that question back in December, I'd have said, you know, it's up for grabs. I would have thought, you know, because of the possibility of convergence and the FASB indicating they were looking at alternative models, ways of spreading the impact and kind of easing it into equity so that it didn't have such a dramatic one-time impact on equity. I would have said, I don't really know which way we're going to go, but I think over the past 2 months, the indication has been that at least if they're going to not converge and really keep going their own way, that kind of indicates to me that FASB has more of an intention of going with the CECL model or something that looks more like the CECL model. So I think out of those alternatives, if I had to put money on one, I'd put money on the final standard looking more like the proposed standard than I would have guessed back in December. And so I guess that gives me a little more clarity because I wouldn't anticipate them if they're going to issue something by the end of the year. There's really not a lot of time to put together another exposure draft to re-expose something that's dramatically different before and gathering those comments before issuing a final standard. So those indicators to me make it seem like that final standard later this year is going to look a lot more like CECL than I had originally anticipated.
All right, thanks, Todd. That's helpful insight, too, and appreciate you being able to share that with us. So let's transition from here. We got the background. We understood the comment letter themes. We walked through recent developments, which are certainly telling. But now I want to move the discussion more to, okay, it appears that, you know what, unfortunately, unless you're an examiner or regulator, it appears like the CECL model's coming. And the poll question we just did indicated 10 to 50% is agreed by more than half the audience on this call. So, you know, what at this time can we be doing to prepare for this model? And that's where we want to focus. Now, first, I'd like to start with this slide. What should institutions not be doing now? And I say that because Americans, we seem to have extreme reactions or knee-jerk reactions. We always seem to go to one end or the other here. You should not be building projected model based on the current proposal to the T, putting time and resources into that. I don't think that's valuable to you right now. And Todd, I'd expect you to agree there significantly based on previous comments to that. But on the other extreme, I don't feel that waiting for final guidance at this point, given where we are, walkthrough, is the right step either. We don't need to wait and see. More than half the audience agrees that it's going to have a significant impact on your ALL reserve, therefore impacting capital and earnings. So it's not wait and see, but it's not put all these resources into building up on the proposed model. Todd, I know a lot, maybe not a lot, but a significant amount of people on the call today have either heard you say or possibly written something where previously you had said maybe a wait and see approach. What would your thoughts be at this time?
Yeah, Ed, I would have, and just kind of going back to what I just spoke to, because of I think it is more likely that the model as exposed and proposed is going to be the model that we have going forward. I think that right now I expect that final guidance to look a lot more like that proposed guidance. Thus, I would say waiting for final guidance it's not going to give me much more clarity. So if we throw out the thing that can screw that up would be convergence. If FASB continues along the current road, I really see final guidance looking like proposed. So I read now proposed guidance and say that's probably what that final guidance is going to look like. So I should be understanding it and preparing for that with that expectation as what it's going to be like, what we're going to have to live with as an industry moving forward.
Okay. So on that note, I want to, of course, transition in a different direction. Then what should they be doing now? And I don't think there's an answer to get in line for this model, but understanding where we see a lot of community banks kind of struggling with that's going to be involved in the future calculation is going to be maybe that deeper, more granular level data, also described as loan level, right? The proposed model certainly is going to ask you for a lot more information about your loan portfolio and the history of it to be able to objectively perform the calculation. So that's where we want to start is what should they be doing now? The guidance isn't out yet. We see it's coming. Well, here's what you can do and likely should be doing. It's been a struggle for community-sized banks to be capturing all that data. So that's exactly what we're suggesting. Why are we saying loan level detail is needed? I put up here one example. The first top half of it is a scenario that is likely being done by several institutions on the call today. You'll recognize that as your FAS5 loss rate right now, charge-off minus recovery over an average balance, annualized times 4 for each quarter. Formula below, let's just say, in theory, you have 8 pools. There's roughly 5 fields you need to capture at each time period within each pool, and you're doing a 12-quarter or 36-month look back. That could take about 480 fields of data when you just sort everything out. For most institutions, about north of 80% at this time, they're still doing that spreadsheet-based at this time, and some have trouble with it, but a lot are having success. They're not having not too many issues, and examiner feedback has been okay to that. Now, below that, we've basically taken the same formula but input some different qualifiers as mentioned in the proposal that's asking for that for you to consider with the average lifetime within each risk rating within each pool, which is requiring kind of that loan level detail capture needed under this scenario. And if you make an assumption of 2,000 loans and 10 fields and let's say an average life duration of 7 years, looking at each quarter, you're going over 500,000 times data to that. Now again, that is one example to the other. You may be capturing a little bit more data if you're already doing a migration analysis, for example. For those of you just doing that basic view and having to go to the example we've laid out, that is a significant increase, and a lot of community institutions are limited with being able to objectively make that calculation in the future. Again, I mentioned this one proposed. It's not necessarily an unlikely one, but it's not out there yet. Todd, when you and I were discussing this, prepping for the call, you had an alternative solution of what maybe you need to be considered in tracking as well. Do you want to propose that?
Yeah, I think what I was thinking about and looking at was what data do we need? It's one thing to start gathering data, and it's kind of like you get into the thing of where do you start and where do you stop, right? Because you don't want to gather a bunch of unnecessary data that you don't need. But and so in kind of looking at the alternatives of what kind of data might I want, if I literally go back to the standard, it talks about the cash flows and discounted cash flows. So does charge-off information really give me what I need? Because if I think about the life cycle of a loan, and a borrower makes payments, and then at some point they stop making payments, or the payments decline, then I've got a period where I'm in discussions with the borrower. We go through downgrades. We go through the process at the institution. You set specific reserves at some point when you think it's impaired, when you're not going to collect all your principal and interest, and then you go through the process, and then the loss may not be confirmed under the current model for a while. So your charge-off is going to lag for a while between the time the borrower stops making payments and the time you actually have a charge-off. So the question I raised, and that I'm raising to others, is well, what does that mean? Does that mean that, should I not be gathering charge-off data? Should I be gathering more payment data to determine to be able to set myself up more accurately because of that lag? Might be a 6-month lag, might be a longer lag in terms of when cash flows stop or dry up versus when we charge off, and how do I address those timing differences? So again, looking at what data do I collect, I would hope that and think that there would be some additional guidance that would be forthcoming that would kind of help us clarify some of those things. But that's an example of what might it look like? Might look more payment collection, which I think in our discussions, you had set out those data parameters. It would mean even more data than that if you actually had together payment data versus simple like charge-off data, right?
Right. I'd agree. Alternative calculation you proposed, but again, that would be even more data. Need to know the payments and the timing of those payments, and what type of loans they're associated with, and whether you even consider the NAICS code and risk rating at the time. I mean, that's a significant amount of data needed, and right now, the feedback has been institutions aren't doing a mediocre job, but we're doing a poor job in storing that data over time. And it's not necessarily, the proactive thing certainly would be getting as much of that data as you can going forward, prepping for this new model. Otherwise, that could lead to more subjectivity, certainly in a calculation in the future, if you don't have that data to help defend it. So, as Todd was speaking, we certainly moved to the slide, which he kind of hit on it. Is so what should they be doing now? Back to our point is understand the data components needed for the new model. To make sure your data collection process and integrity of those is certainly improved. It was just getting the feedback that has certainly been a difficult process for institutions in the community bank size. We want to continue to move. This is a little bit more detail, what's being done now versus the proposed one that we showed here. It's just walking through, when we made those assumptions, what additional fields are needed. You can see on this example some of those additional fields may be more in line with a migration analysis for those of you performing it. And that is, for those of you doing migration analysis, when you went to that level, that was certainly a transition for your institution and the amount of loan data need to be captured. And this is very, very similar to that under this proposal. Certainly the alternative Todd suggested would require even more data. But putting these side by side, it shows how significant an increase that can be. But let's say, Todd, I want to propose maybe a different view from here. Let's say an institution continued just the basic historical loss rate capture, the column on the left. The model was released, okay, still, but let's say they waited however many years they had for implementation, and they didn't have the data they needed to objectively calculate the ALLL. Where do you think institutions would likely look?
You mean like, normally if you were in a situation like that when you didn't have the data, maybe you'll enter it would be maybe similar to a new area of lending, right? Is that
yeah, that's yeah.
Yeah, it's kind of where you lack historical data, and there's been some guidance and some provision, I think, under the incurred loss model that in those instances you can look at peer data and get an indication from peer data as to what factors you would use. The challenge of peer data, I think, in switching to a new model, and why I don't know if that works real well, is, well, do your peers have the data? If your peers aren't, if everybody's in the same boat, are you going to be able to look to peers? so I don't know that that'll exist. And second, that the model, as it's written, doesn't make a provision for falling back on peer data for some of that analysis. It might be used again at a high level to compare to peers, but I don't think you can substitute peer data for your own data according to how this model is constructed or currently proposed.
Yeah, thanks for that feedback, Todd. And that's what we have heard, the same as well, speaking to other financial institutions, that what would they do? The fallback, the common answer has been, I'd probably go to peer data. Like you said, de novo institution or one looking at new line of lending, that's typically where they've gone under the current model. That has been overwhelmingly the most common answer to, okay, well, what would you do? We've also heard answers of whether they'd potentially hire an outside consultant for help. I don't know how much help could be provided there. Also heard the answers like, well, once it's proposed, we're going to manually start backfilling that data. I don't think there's a realization of how much data may be there as well. So that seems to be the only true answer that could be helpful to it. But I want to walk through, if you go that way, what does that mean? And what can be the impact and how can that cost you as well? So we have an infographic up we're going to go into understanding that. If you're going to use your peers, if you don't have that data, how can that impact you? So I want to zoom in a little bit on this infographic we have. And obviously you can see this is a little bit of a flow and kind of question and answer to yourself here. But what we've kind of looked at so far is under this proposal that it's very likely to come out this year that's looking to require more granular detail. That model is going to be likely a more complex formula and likely 1,000 times more data if you're only using that most basic calculation at this time. If you are capturing that data and you need now, great, you're starting to put some of that away in place for the changes. You'll certainly be more prepared than your peers are who aren't preparing at this time. But if you're not capturing that data, and I apologize, we're zooming all over for a moment. It'll settle down now. If you got motion sickness from that a moment ago, that's my fault. If you're not capturing that data, you very well may say, I'm going to rely on peer industry data. But a lot of the time, the peer data is not necessarily reflective of your institution. Your institution isn't the same as the one down the street. It's not the same as the one in the south or the west coast or the east coast or wherever it may be. So let's say you use peers, though, and you have your reserve rate is higher than average. Use peer data. That can certainly risk your bank's safety and soundness on that side. That can have complications from it, too. On the other side, if you're a better performing bank, let's say your reserve is lower than what's well perceived to be the common 2%, that may have and cause you to increase your reserve even more. I mean, it's already being proposed that you may have 30 to 50%, according to Thomas Curry. Again, half the audience believes in that too. So if that's the case and you're a better performing bank, that can be significant even more and certainly have an impact on capital and profits, earning, lending, and all the extrapolations that go with that. But the biggest takeaway just to understand is if you're using peer data, and Todd, you pointed it out, the peer data that exists now, which is commonly the UBIP or UBPR, the data that exists now really isn't to that loan level. It has nothing to do with the loan durations or payments or a longer horizon. It really doesn't exist. So all in all, it's going to introduce more subjectivity into your calculation. I think the majority of us on the call are trying to actually remove subjectivity to our calculation. So not having the data can actually lead to more of that being in your model. With that subjectivity can have a negative impact on your calculation. So I want to go over here. What if you don't have the data? That's where we started. Most said UBPR. Well, again, that's going to be less robust, more subjective, and scrutiny from the examiners. If you want to take that a step further, if you get more scrutiny from examiners and you can't be objective, you're giving the examiners more control. Okay, the regulatory bodies like the OCC have just come out and told you they expect the increase to be 30 to 50%. By not having the data, you are giving them more control, and they told you where they want to be. So they're going to go ahead and make those quote, and I'm using the air quotes here, that 30 to 50% increase in your reserve at their suggestion, and it's giving you less control. You don't have the data to minimize that impact, and that's going to lead to having a direct impact on your earnings and your capital there. So that can be a big issue for you and can lead up to that 50% increase since you can't defend it. Todd, is there anything you want to add to that? Would you agree with that kind of line of following there? Not if you don't have the data to be more objective and the impact that can make?
Yeah, I would. Still recovering a little bit from the motion of the slide, Ed. It's kind of like watching a webinar on a small boat that's listed in the ocean. I should have warned you about that motion sickness that I have, but I think you're right for the most part.
All right. I appreciate that, Todd. I didn't mean to get you too motion sickness there. That was my fault. So want to keep going here into the loan level detail and talk about capturing this data and hit on some of the points and talking about the solutions that exist. All right. When we capture the data, we're hoping with having that we can minimize that expected increase and remove that subjectivity. It's hard enough now to remove that from the qualitative factors. Let's prevent it from coming into other areas of our calculation. Again, as I mentioned, it can help objectively defend, and without it, there can be that additional criticism. Well, how can you capture that data? That's likely the other point of. Some certainly are saying I'm already doing that. Some say, what are you talking about? And others may have proactively started. Certainly, we've got kind of 3 solutions listed on here. I wrote the limited method, and we using your core system. I think most institutions are possibly muttering under their breath that, well, yeah, our core has that data. Speaking with institutions, we have found that to be that most cores don't go past 13 months worth of loan level detail. It's been pretty hard for them to gather that after that point, that it just kind of falls off. And cores are aware of that. We've spoken with some cores who give an indication they'd like to improve that process, but no core company that we've worked with moves fast, and I think some of us on the call are aware of that. Maybe there's also what we call the static method. Some institutions who have been proactive wanting to do something now have taken this plan or taken this path. And what do we mean? Well, they recognize the shortfall of a core, recognizing no more than 13 months, and those are some of the better ones. Yet they have a report writer and data warehouse tool. So what they're doing is getting the report writer to pull the data from the core and essentially then store it in this data warehouse. Now, that's beneficial as they have the data, but in a way you could say it's kind of like dumping it in a landfill. For the most part, it can be unorganized and different to be available for use. You do have it, great, but the difference between maybe data and organization, the data and information is how you organize it together. And really, when you're doing it in a static method, you may be limiting the ability to do queries with different pieces of data all at the same time. So keeping it organized and then dynamic is very important. Now, I call the dynamic method is using an automated solution to capture and store that data, right? Todd, you proposed a question to me when we were planning for this call, a situation you were in, where you had mentioned you had a client who had proposed, okay, well, how much data? And you mentioned that early on the call, where do I stop? Well, the old adage, better safe than sorry, is a way I'd like to approach that. But using the static method, if you're doing that in-house, for each additional column of a field you want to put aside, there's a man-hour expense to that. There's an expense to, okay, instead of doing 60 columns, I want to do 70 columns of data for each ending month or each ending quarter. There's an additional expense and time into that. Using kind of automated third-party solutions to help capture and store that data and make it immediately available for use in a dynamic fashion, once you go that method and get the mapping set, whether you're doing kind of one field at the end of each archive period or you're doing the max of your core way over 100, there's no difference there. There's no increased resource having to be done. So that's the benefit of doing through a dynamic method. So even if you are maxing out using all of your user-defined fields in your core right now, you can store that and make that ready for use immediately. And so when the final proposal comes out, you have all of those to reference anything you need to help objectively defend your calculation going forward. Todd, anything you want to maybe add to that as well? I know maybe I took over and you had to recover and maybe get a Dramamine after that motion sickness, but anything else?
Yeah. I'm back on board now. I'm good. But I think you're right, Ed. I think the reason I raised that question is because when you talk to folks out there that would have to implement this, the question is, I don't have enough time to do what I'm doing now. How am I going to have the time to start the process of gathering this data? And you're right, under this, because that's what I was assuming when I proposed that, was under a static method. you know, if I want more data, that's just more hours. You know, if I end up gathering a bunch of data that I don't end up using, that's more hours of my life I'm just not going to get back someday. And now I wasted that. You know, I don't have those precious hours to give or that manpower to dedicate to this kind of process. So that's a lot of the implementation, or I'll say a lot of the implementation concerns that I'm hearing lately is about being able to do this, especially in the current environment when the institution has other things that they're struggling with in terms of coming back to profitability and being able to catch your breath before moving forward. So that wasted energy and wasted time, I think, is a big concern right now.
Thanks, Todd. And for the audience as well, after going through that and understanding the need for this data with the model likely here on its way, we want to go to our next poll question as well. If you take just a moment to continue to be interactive. And it's a way for us to check your pulse as well, see if you're on your toes. Okay, let's go to this. After understanding kind of these needs for the model and the data we just discussed, do you feel you will be adequately prepared? And if you guys could just take a moment. We've got about 25% have voted, and wow, that jumped to 40 before I finished that sentence. We will get an answer here. And this is very helpful, actually. It's interesting to see coming across. Guess what? 75% voted. Obviously, you're awake. And let's go ahead and just 5 more seconds. We'll cut this to an end. And we're hitting the 80% mark if we want to go ahead and pause this. And let's go ahead and share these results. And it's very, very interesting. I think this speaks loudly to, again, why there's so many registrants on this webinar, why this is so important, and that there is hopefully being value taken away. We've got, you feel you'll be adequately prepared. Well, a quarter of you sounds like you're being proactive and that you're doing something, taking a step. Either that can be a current client of Sageworks using the surety product at this time to help with that, storing that data, or you're using that static method but doing a better job or have another solution to it. That's 25% of you. Great. We see the other 58% is, no, not right now, but I sure plan to address that. And that speaks to this may have uncovered an issue that you need to come up with a solution to. Very few went with the no, I don't plan to make any changes. Okay, great. And then 14%, I think, were just completely honest, I don't know. And that's safe to say, right, Todd? You can always say, I don't know if I'm going to be prepared until it's finally done, right?
Ed, I say I don't know a whole heck of a lot.
Well said. Well said. Well put. Well, let's. We talked about capturing that data, but there's more to that data. There's more benefits. Don't want you to think that we'll only say, hey, you need to do it for this. We've put together some bullet points here for you. You're listening. How else can that be applicable? Certainly if you're transitioning to migration analysis. Now, that's a webinar all by itself on what is that if you're not using it and how that can help. But for institutions around the 500 million mark or greater, if you're not using that, we usually see maybe regulators start dropping that hint, wink, wink, or this is optional kind of to you. It could probably help developing your own PD model. Certainly can provide more defensible calculations, be more objective, can do some additional reporting options, can certainly help with those financial disclosures when you do those reportings as well, even some additional reconciliation and audit trails also. Yeah, Todd, anything that comes to mind as well? Anything may have missed on these bullets that would be other benefits?
No, I think you got it pretty well covered, Ed.
All right, I appreciate that. Well, Todd, kind of as we've gone forward this with this data and the importance of it, with Cecil likely coming out, what are the expectations coming forward in your mind with the model?
Yeah, where do I see us moving in the rest of 2014? On the first point on convergence, I think, as I've probably already said, I think that's just unlikely. I still would have hoped, I still do hope, tell you what, I set out next, I would, convergence is a good thing because I think convergence delays implementation and keeps this process kind of kicking the can down the road. And while I would still kind of hope for that solution, I think I'm leaning to the fact that that's just not going to happen the way things have been proceeding in the communications that have come out of FASB recently. So as I look, yeah, we can expect the final standard to sometime at the end of 2014. And what can we look for? Well, I think if that's going to be the case, based on all the comment letters that have been issued and the industry concern about this model and the untested nature of this model, I would expect some some more guidance or supplements, let's just say, to the proposed model from the standard setters and from the regulators. First from the standard setters, and trying to give a little more clarity about what they mean on some things, what implementation might look like. And then from a regulatory standpoint, just like we had interagency guidance in 2006 to shed more light on what their expectations were from the incurred loss model, I would expect some similar type guidance for this new model. But what I'm not overly optimistic about is that the timeliness of that regulatory guidance that would come out. But I do expect there to be a longer implementation period for the standard. 2 to 3 years, I think, has been communicated. From what I've heard back, that's been heard loud and clear by standard setters, and that the implementation period wouldn't be, I don't think let's put it this way, I'd be very surprised if the implementation period for public institutions was less than 3 years. So that looks like with the way standards have been going, a 3-year kind of implementation period for private institutions or non-public institutions. So I'm looking at that kind of implementation period going forward, but I'm not necessarily optimistic that there'd be a lot of regulatory guidance that would come out immediately after issuance of the standard or shortly thereafter that would provide guidance in that initial implementation period. So I think you'll still be looking for that. And along those lines, I get asked, a couple questions. One question typically is, well, maybe I just start booking it now? Maybe I start, I know there's regulatory pressure to keep the allowance at levels where it's at and not take negative provisions or decrease it. So maybe I'm just better off building some of these forward-looking expectations into my current model. And I'll tell you, we all know that kind of is naturally occurring to some extent, and it's occurring through qualitative factors. But I caution institutions from booking too much of that, or trying to get to the point where at implementation there's really no change in the allowance. And for this reason is I think if everybody in the industry were to do that, that might be fine. But if you take that proactive approach and book too much so that the impact of the expected loss model is really booked before you implement the model, and your peers don't do that, then when folks look at that UPBR data and compare you, they'll say, well, everybody else had that, say, 30% increase upon implementation. You had 0. We think you should have 30. And so you might end up almost shooting yourself in the foot, and that you would be held then to even higher amounts. So I expected there, from a regulatory standpoint, from an analytical standpoint, to see some pop at the time of implementation. So I kind of caution folks on building those forward-looking expectations too much into their current analysis. And then I think there's a lot of implementation guidance that needs to be provided, because as we expect to go through a period here where we can see some acquisition activity, merger and acquisition activity. What do you do with a target that you've acquired, say, during that implementation period, who has not properly gathered data or done anything? So you're going to lack that historical data. And while you do mark that portfolio to market and essentially capture the net present value cash flows that exist in that portfolio, it's that's one of those instances where you're really not going to be able to go back and realistically get any historical data, and so you're going to have to make some changes. And how do you do those type of things moving forward? So that's kind of what I see moving forward as we go into 2014, 15, and beyond, and look at implementing an expected loss model in the future.
Yeah, Todd, that's great insight on the own questions I think you brought up and asked yourself. I think at least one of those was already suggested on the Q&A that we're going to be starting shortly. So I guess way to be proactive. And to add to that, that's something Sageworks has seen too, working with institutions, is, why don't I just go ahead and be prepping now? As long as I have a higher reserve than most, they won't have any issue with me. And I think you exposed a concern, a potential risk is, they may still say, look, your peers moved in, why haven't you? And especially if you don't have the data to objectively defend that, you very well may get kind of doubled, or double up, if you would, while going about that methodology. So At this time, we are quickly approaching the Q&A session and the end of our hour allotment. We have about 10 minutes left. Before we do that, we do have two final poll questions, and then we're going to do our Q&A. Now, at any time, you can be in the chat box, be typing in your questions. Please don't hesitate to go ahead and submit those. But we're going to go ahead and put up one of our two final poll questions. This is, would you like to speak with the Sageworks ALL specialist about an automated solution that will help collect and archive the data required by the Cecil model? We're not going to share this. This is just internally feedback. If you can go ahead and speak to this, that would be very helpful. Right now we're at 25%, and if you can go ahead and respond, we're getting to 40% very, very quickly on this response. That would be great if you can. But 57. Guys, appreciate it. As this webinar, one of our largest, it's also been one of the most responsive. So we're going to take about less than 10 more seconds coming up so we can get that answer coming across. All right, guys, we're going to go 3 and 2 and 1, and we're going to go ahead and pause that one and then follow it up with one more real quick. If we can just launch, would you like to learn more about the services provided CliftonLarsonAllen? Again, top 10 accounting firm if you're unfamiliar, and Todd is certainly a principal with one of those, and he is a great face of the business and a pleasure to work with. So I'd encourage you. If you
make me blush. You make me blush, buddy.
with that large head of yours from the picture earlier, that's a lot of blushing probably going on right now.
Yeah, those were to scale. Not many people know it, but my head is literally twice as large as yours.
What is your hat size? 9.5? Is that right?
All custom, buddy.
All right. Well, it looks like we've gotten some feedback real quick. We're at 75% on that one as well. So that was great. So guys, at this time, I'm going to turn it back to Billy, who's been our moderator, and then we're going to go into the Q&A session as well.
Great. Thanks, guys, and thanks for that terrific presentation. We do have a few questions that have come in, so we are going to address those. But quickly, just wanted to review the information on this slide. So you will receive an email this afternoon with a link to our FASB Cecil Toolkit, a complimentary kit of resources. And within that is, items like the infographic that you saw today, as well as today's presentation slides, and finally, the recording of today's presentation if you'd like to go back and watch or pass it along to a colleague. Encourage you to join us for our next webinar. You can see the link there. We're going to be discussing backtesting your ALL, and you can see the link there and go ahead and get signed up for March 21st. Also, we encourage you to join our LinkedIn forum for bankers, ALL Forum for Bankers. And then finally, additional ALL resources can be found on SageWorksAnalyst.com. And you can also see Todd's and Ed's contact information there. I encourage you to contact them with any further questions. So at this time, we're going to pause for just about 30 seconds while we review the questions that have come in. I just saw a flurry of them as I was reviewing the slides. So we're going to review these and be back with you in just a moment.
Hey, Todd, we'll start you off on the first one because that's the easiest thing to do. Does the expected loss model replace both FAS 5 and FAS 114?
Yeah. I think what we're looking at is, yeah, that you would be just going to the more of a discounted cash flow method of analysis than you would setting any, while that's a basis for setting those expectations on cash flows, I think you really are out of FAS 5 then, because that's where that probability threshold comes from. And then on the impaired analysis, realistically, I think when I talk to the folks in the standard setting process, what I've been discussing with them is that the impairment analysis for a community bank is different than what they may have expected. I think they had a much greater anticipation that when you, as a community bank, analyzed an impaired loan, you were doing so on a cash flow, discounted cash flow method versus a fair value of collateral less cost to sell. I don't think they thought there was much use of market value, which was right, but I really think they had the balance wrong. So there's been some discussion about that truly is for an impaired loan calculation, and specifically to TDRs too, on TDRs that get evaluated as impaired loans, it would be a significant change in the way you would calculate those reserves on impaired loans.
I actually have a follow-up question to that. Is the proposal contemplating the present value of cash flows to be more of the basis of reserving, charging off going forward versus being heavy on the collateral side?
Yes. Yeah. Yep. While I think my expectation is, again, if you are collateral dependent, you would be again looking to that as the source for generating those cash flows. So you would look at the sale of that collateral and discount that back, essentially a lump sum payment, and trying to estimate when that lump sum payment upon liquidation of collateral would come and flow back into the loan. But yeah, really it comes back to cash flow.
Todd, what I think is a great question. Made me smile a little bit in the way it was asked as well. I'll read it to you verbatim. You mentioned knowing where we are in the economic cycle when projecting losses. Is anyone was in all caps, is anyone qualified to determine that, much less accountants at a bank?
That's a great question, because no, if I had that kind of knowledge and data, I probably wouldn't be giving this webinar today. I might be doing something, putting that knowledge to other use. But you're right. I think that's the challenge also, and that has been heard, at least heard by I think standard setters through this comment process. And the great thing about the volume of comments from community banks that have come in and from credit unions that have come in and commented on the process is that the standard setters really did read those and take into account what a task this is for the industry as a whole.
Todd, you're staying sharp with all these that are coming in. And audience, for those of you still on, and we see a significant amount of you, still continue to ask some questions as we finish up here. There's another one that came in. Fair enough, another question like the same. Do you believe that we would have had a still significant kind of crisis, if you would, in a banking market if we would have had this model versus our current model in there? I'll take a quick stab. Well, actually, Todd, you go ahead and go first, and I may have some additions to it.
Why not, Ed? I'm on a roll. I'm answering all the questions right now. I was wondering when you might take one. So, no, I think that is the consensus is that no, this would not. To state it pretty plainly, I think we would have had that this model would have functioned poorly coming into that crisis, and it is a knee-jerk reaction to that crisis. I think it's foolish to believe that the industry would have properly anticipated it. In short, I think that one of the criticisms from the regulators was that the qualitative factors of financial institutions did not rise as quickly as it should have, and so if financial institutions weren't able to change those qualitative factors as quickly as they should have been, how would they have adjusted their expected loss expectations quickly enough to ramp up reserves? I think it's folly. Again, I think we're just going into the next time this happens, we're just going in with a model that we don't know how it's going to react, hoping it might react better, but I really don't have the expectation that it would react any better, because I just don't think the community had that kind of visibility into the extent and timing of those losses. So I don't think it would have changed a thing.
I agree with you on the majority there, Todd, that it would have been difficult to tell, and that you pointed it out earlier, but when we go into our next crisis like that, we don't know what to anticipate given we're under a new model than we used in the last crisis. I think one of the thoughts was, right, we had over, 400 financial institutions have now failed from that crisis, and the thinking being, well, if they would have had additional reserve mixed, therefore being in additional capital, that they maybe would have been able to survive it a little more. Of the 400, sure, could that have had an impact? Sure, but likely not a significant one. So it could have made a difference for a few, but for the most part, I'd agree with you, Todd, that it would not have had anything significant to it. So I'm giving the the signal from Billy here, who's been, again, our moderator, that we have ran out of time at this point. For those of you who did ask a question, we're not going to ignore it. We are going to follow up with you individually. You'll get an email from one of us here at Sageworks and or from Todd as well. So just want to thank you one last time for being part of this webinar. And Billy, did you want to add to that?
Yeah, wanted to obviously thank both Ed and Todd for joining us today. And just another quick reminder that you will receive an email later today where you can access both the slides from today's presentation as well as a recording of today's presentation. So with that said, I think I'd like to close it out and once again thank Ed and Todd for a terrific presentation and all of you for joining us on this Friday afternoon and hope everyone has a terrific weekend. Thank you.